Moving average, another indicator in technical analysis. Now, why we cannot consider average as an indicator in technical analysis? Because we understand that the price of a particular stock will change every day. That means we cannot have the average, but instead we need to have the moving average for that particular stock. Now, if you see, moving averages are price based indicators. It can be defined as the average price of the portfolio or market over the last n number of period, could be 20 days, could be 21 days, could be 26 days. The simple moving averages can be classified into two types: short term moving average and long term moving average. So the short term or long term depends on what moving average you are taking in terms of duration. If you're taking it for short duration like 10 days, 21 days, it will be forming for short term. In case you are taking it for longer duration, it will be long term moving averages. As you can see here, this MA represents moving averages. As you can see here, the red line will be representing the long term moving average, and the blue line represents the short term moving average. This is how we plot the after calculation of moving averages in the graph. Now, calculation of these moving averages will be shown in a separate video where we are going to record it in Excel. We'll show it in Excel how you calculate the moving average and plot it as a graph. Now, this moving average can also be further subdivided into simple moving average or an exponential moving average. So simple moving average is also indicated as SMA, is formed by calculating the average price of security over a given period of time. That's the normal way we are calculating the simple moving average. But when it comes to exponential moving average, we are giving more weightage to the current price, and we are not distributing the weightage equally to prices for all the duration, but in exponential we give more weightage to the current prices. Hence, moving average, exponential moving averages or EMA, is formed by calculating the SMA to start with. That's the basis to start the calculation of EMA. SMA becomes the basis, that is simple moving average becomes the basis to start the calculation of exponential moving average, and then putting more weightage to recent prices. The formula will make it more clear to you. So for simple moving average, whatever is the close price or adjusted close price for a particular stock price, we take that and we add it up and divide it by number of days. Suppose we are calculating it for 21 days, we add the prices for all the 21 days, close price or adjusted close price for 21 days, and divide it by 21, we get what is our simple moving average. But when it comes to exponential moving average, the formula is 2 divided by n plus 1 into bracket open current close, that means the closing price of the current day, minus previous EMA, whatever exponential moving average you have calculated for the previous day. This you deduct it from the current close, and then you close the bracket and you add previous EMA. Now, what should be the basis of first EMA, because you don't have any EMA previous to that, so you take SMA as the basis. The SMA becomes the initial EMA, and then you calculate your next EMA basis the current SMA or previous SMA, and then for subsequent EMAs you can take the previous EMA and use it in the formula. It will become more clearer to you when we are going to do it in Excel. Now, initial EMA, as I told you, is the simple moving average for previous close. Now let's go ahead and see the next indicator. Alright, so here we are trying to figure out how to calculate moving averages in Excel. Now, what we discussed in our video lectures is that moving averages will be generally for two types. One would be your simple moving average, another would be your exponential moving average. So we are going to see how do we calculate both simple moving average as well as exponential moving average. So as you can see here, I have certain data on my screen. So this data are for some companies, stock prices, where we have got the open price, we have got what is the high price in a day, what is the low price in a day, and what is the close price. Now, if you remember your candlestick, we can create a candlestick based out of this, where we have the open price, we have the high price, we have the low price, and we have the close price as well. If you see, the open price is 100.59 and the close price is 99.18. That means there has been decrease in the price for that particular stock on this day. Now, if you see in the second data, from 99.27 was the open price and the close price was 99.90. This means that the price has actually increased. Depending on this, we can select what should be color of our candlestick. If the prices has increased, it should be green in color. If the prices has decreased, it should be red in color. And also you can see that the highest price that has touched for this particular stock in a day is 100.69 and the lowest price is 98.70. So given all this data, if I put it on the graph and create a candlesticks, this all data will be visible there. So that is one of the technical indicators, that is candlestick. Okay, now let's come to some other indicators that are moving averages. And as we were discussing, moving averages are of two types: simple moving average and exponential moving average. So as we can see here, simple moving average, we need to calculate it for 5 days. Now why do we calculate moving average? Why don't we calculate average alone? As we have already discussed, since the prices of the stocks are fluctuating every time, every day, right? So it's not justified or it won't be justifiable to calculate a plain average for these stock prices, but instead we need to have what is the average price of this stock on the moving basis. Now to consider this simple moving average calculation, we'll be considering close prices only. We'll not consider open price, high price, low price. We'll only consider close price. So as you can see, SMA 5, that means we need to consider the simple moving average for 5 days. So the formula would be very simple. We will be using is equal to average, and then we will be pressing the tab, the bracket gets opened, average is selected. We'll select this 5 days for which we are going to calculate the moving average or simple moving average, and we will close the bracket. And here we go with the 5 days of average for this particular stock's closing price is 99.41, right? And if I double click it, or since the double click is not working here, so what we can do, we can drag and drop this. This is called autofill function, and we can drag it for the entire data. And as you can see here, we have got moving average for every day. These all are 5 days moving average. So this is how we calculate 5 days moving average for this particular stock price. Now if you see, the next simple moving average that we are going to calculate is for 21 days. Hence we'll take the average of 21 days in the similar fashion as we took it for 5 days, and we are going to apply the autofill function to get the average for remaining days. So simple once again, for this 21 days I use average as a formula, press tab, bracket gets opened, formula gets selected, we need to select the data. I have selected this 21 days data, I have closed the bracket and I press enter. 101.15 is what I see as a simple moving average for 21 days on 10/21/2017 or 21/10/2017, that is 21st of October 2017. Now I just use my autofill function. I just drag and drop this data from right hand side corner, and here I go and I get the simple moving average for all this duration. So this is how we can calculate our simple moving average, right? In case you have not understood how to do it, you can re-see this video from here and you will understand. We have used the average function for these 5 days, and we have used the autofill function by dragging and dropping this formula in the remaining cells, and we get the 5 days simple moving average. Now let's go to a little bit more tough to calculate moving average, that is your exponential moving average. Now remember, we discussed that exponential moving average, we use it because we want to make sure that we give more weightage to the close price when we calculate the moving average. The formula that we used was 2 divided by n plus 1, and we multiplied it by bracket open close price minus previous EMA bracket close plus previous EMA. I'll just write the formula for you once here. So calculation of exponential moving average was, here what we can do, we can say bracket open 2 divided by bracket open once again n plus 1 bracket close and final bracket close multiplied by bracket open close price, because we are going to give weightage to close price in our calculation of moving average. Hence we say close price minus the previous EMA for n period bracket close, whatever is the result will be adding previous EMA for n period into this. So plus previous EMA for n period. Now this is the formula we will be using for the calculation of our exponential moving average. So here we know, since we are taking exponential moving average for n period, n is 5 days here, so it should be 2 divided by 5 plus 1, that is 2 divided by 6. Now one more thing we should remember, as we had seen in the video lecture, that first EMA would be your simple moving average, because here in the formula we are saying close price minus previous EMA plus previous EMA. Since we do not have any previous EMA for the very first data, we'll consider the first data as simple moving average only, and from next data this simple moving average will be acting as a previous EMA. So let's go ahead and do it. We'll be calculating simple moving average for exponential moving average calculation for the day 1, that is the 5th day. So this should be is equal to average, as we know the formula, tab bracket open, and we select this 5 days of data and we say enter. So here we go, we got our exponential moving average for first day, which will be nothing but your simple moving average. Now from day 2, that is from EMA for 6th day, now this will act as your previous EMA, and your closing price 100.80 will be your closing price that we are going to use in our formula. Now n, you should remember, n here is your 5. So basically your denominator in the first part of the formula will be 2 divided by 6, that is 5 plus 1. So the formula will be is equal to bracket open 2 divided by 6, which is basically your 5 plus 1, n plus 1, bracket close, multiplied by bracket open. You select your close price, which is 100.80, minus your previous EMA, which is 99.41 or H9, bracket close. You'll be adding to the entire result previous EMA, that is your 99.41, and then you press enter. So what you get is 99.88. this is your EMA for the 6th day. Now you can use autofill function, that is basically your drag and drop, for the calculation of balance EMA into the balance cells. So here we have got EMA for our remaining days, or for the entire duration for which we have this data. Next is your EMA calculation for 21 days. So let's go ahead. Remember, the first would be your simple moving average. Hence, you can use the very simple formula is equal to average for the entire duration, which is 1st of October onwards for 21 days. And then we close the bracket, and what we get as 101.15 is your 21 days EMA. Now next formula that we'll be using will be your proper formula for your EMA, that is 2 divided by n plus 1, bracket open, close price minus previous EMA, bracket close, previous EMA, which we saw here. Right, so let's do it. we say is equal to, now n is 21 here, so we'll say bracket open 2 divided by 22. Since we are saying n plus 1, 21 plus 1 is 22, bracket close, multiplied by bracket open close price, which is basically 106.98, minus your previous EMA, which is 101.15, bracket close, plus previous EMA, which is your 101.15, and we press enter, we get 101.68. so this is your EMA for 22nd day. We use drag and drop function for the entire data, and here we get the EMA calculation for this entire duration. So you have just seen how to calculate simple moving average and exponential moving average. We saw how do we calculate simple moving average for 5 days, we saw how do we calculate simple moving average for 21 days, and we saw how do we calculate EMA for 5 days, that is your exponential moving averages and exponential moving averages for 21 days. Now you can plot this into a graph by using the line chart, or you can use this data into table format also for understanding the technical indicators. But these are just the start for you to reach to the other technical indicators, for example SMI and MACD, which we are going to see in our further video lectures.